Welcome to the Propertybuyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Welcome to another edition of the Property Buyer Podcast, where we bring you expert insights to help you make smarter property decisions. I'm your host, Rich Harvey. Many of us dream about buying a few investment properties, watching them grow and creating a nest egg for our families, and retiring early to live off the cash flow. We desire a better standard of living and a life freer of money worries and putting up with bad bosses. But what is the reality and the challenges of getting into property with a scaled up portfolio? What are the risks and what are the rewards? And what investment philosophy and strategies are going to work over the next decade in Australia? Well, today we're privileged to hear from a successful investor that started his journey just 5 years ago to create an impressive portfolio quite quickly. Jono Roy is a seasoned property investor and a strategist with a proven track record in Australia. After purchasing his first property in 2020, he quickly gained experience in buying first-grade investment properties. He now has a portfolio of 9 investment properties valued over $4.5 million. And he's also been a part-time property flipper, recently profiting $155,000 on a single project. So he understands the ins and outs of property really well. Being the former head of research at one of Australia's top buyers agency, he played a key role in overseeing the purchase of over 1,000 properties in just 3.5 years. So he's got deep market insights and hands-on experience. Welcome, Jono. Great to have you on the podcast today.
Lovely to be here, Rich. Thanks for having me.
It's a pleasure. Now, John, I'm going to throw you in the deep end. We've got a little quote or thought of the week that we always give to our guests. And the quote this week comes from Anais Nin, who says, "Life shrinks or expands in proportions to one's courage." What do you take from that quote?
Well, I think you have to have courage to move, to take certain risks. I think for me, one of the things that kind of drove me into investing in property was actually fear of staying the same, fear of seeing through COVID my money get eroded in the offset account, and thinking about how much that money would have taken, the time it would have taken me to earn that money, and thinking, well, I need to do something different here because the old advice that would have worked maybe for my dad's generation or his or granddad's didn't necessarily work for me in terms of just getting a good stable job and the rest would take care of itself. So that's what really sort of pushed me to look to see is there something different, and property was where I ended up. Fantastic.
When I look at that quote, if you ask me that question, what do I take from that quote? I was watching a show called House of David the other day about, in the Bible, they've got King David and the famous David and Goliath story. And they played it really well. And his brothers are all like, really, David, you'll never beat this giant. You're hopeless. You're a weed. You're just a shepherd boy. But as he walks out, he goes, I'm afraid, but I've got courage. And it's like a lot of us in life, we have these kind of real points of crossroads in our lives where we've got to decide, do I take that job? Do I invest in that property? Do I marry that person? Whatever it is. And you've got to have the courage of your convictions. And I think that's what I take, that your life will be the same or different depending on the level of courage that you decide to take.
Yeah, 100%. So just trust the process and commit, I think is the thing, and then be okay.
But so many people are scared to commit, aren't they?
Yeah. And they're committing to, you can't not commit, it's just what you're committing to, that's right? So it's like, choose what you commit to.
Exactly, choose your hard. Anyway, look, how did you get started with property investment? What was your motivation to get started? You kind of just touched on it a bit, but unpack that a bit more for me.
So I got started through just education, so self-education, reading stuff online, actually mostly YouTube. So followed a few people on YouTube, and through probably 6 months or so, built up enough knowledge to get to a point of trusting the process and committing. So, where I was in Melbourne, had my own principal place of residence, like apartment there, and my only exposure to property investing at that time had been the real like house and land kind of offerings through mortgage brokers.
Yep, the spruikers.
Yeah,
getting back out of commissions that you didn't know about. Yeah,
60,000 I hear on some of them. It's
crazy.
It's crazy, and I can totally see why brokers and accountants get lured into doing that. But it just didn't feel right to me when I was there. The whole presentations of that kind of product is all about saving tax. It's not really what property investing does.
It's the icing on the cake. It's the capital growth. It's the number one factor in my view. The tax deductions are great, but they come very much
it's
a
very
third,
low.
Fourth, in the priority order.
100%. So I'm glad I didn't go down that path. I nearly did. But because the other thing that was holding me back was just knowing that there were actually properties out there, because my experience was just from what was around me, which was in Melbourne CBD, and average property prices are pretty high there. And so thinking I could afford to hold on to one of those type of properties was beyond me until I realised Australia's a big place, and there are different markets out there, different price points where you can still get freestanding houses for a lot less than $1.5 million. So once I kind of got a grip of those things, then that gave me the sort of knowledge to then go, okay, well now I'm going to start. So.
Okay, awesome. So we're going to unpack this in a lot more detail, but just briefly, how did you go from nothing, 0 properties, to 9 in 5 years? That's a really great achievement. So hats off to you.
Yeah, well, so some of them are my like flipper projects. So some of them are, and my first one was my principal place of residence. I'd done reasonably well in a business that I had in 2016, 17, 18. So I had some cash saved up. I'd got a reasonable amount of equity in my principal place of residence as well, for a bit of the luck through COVID. So that was my starting point, I suppose. I did have some capital behind me. And then in COVID, we had obviously interest rates very, very low. So it was an interesting time. And I had a reasonably healthy sort of household income. So just got the first investment property in September of 2021, I believe. And so that was up in Toowoomba. And then the second one in Perth, South Perth, in like a couple of months later. And they just went really, really well over the first 12 months. And even after a few months of seeing the capital growth that I'd had in these properties, I was starting to think about getting rid of my apartment, because my apartment in Melbourne hadn't really grown that much. From 2016 to 2020, that apartment had grew about 100,000. And I just looked at, what am I actually, like what would it cost me to sort of move and release the equity, and I'm not really sacrificing any of my lifestyle by doing that. So that was something that I did like a year after. So I went from 1 to 2, then I went 3, 4, 5, 6. So 3, 4, 5, and 6 were a year after. Again, this is all when interest rates are very low, and that's when I got stuck. And then I had to sell my. I decided to sell my principal place of residence, but also interest rates had gone up. They started to go up quite a lot. I don't know if you remember, end of 2022, early 2023. And I went back to Westpac, was my bank at the time, and just kind of went, right, I'm ready for my next one. And they said, no, you're not.
You can't afford it.
What do you mean?
What do you mean? I've been buying all these properties. I want to roll. Come on.
So I was like, I had lots of equity, but that's when I really realised, okay, there's another level of this game where
it's called serviceability.
And
the banks are very, very harsh on that, right?
Exactly.
And they've got the APRA rate, another 3% on top of whatever the rate is. So
that's exactly right. So when I was buying, it was lucky because I was in COVID time in that sense, and debt to income ratios were like 8.5%, 9%, or 9 times your salary.
That's it.
So then it went back to roughly what it is now. It's just like 5.5, 6.
That's it. Yeah.
So big shift. So I had got myself in a position where I was quite a way off being able to then afford to buy my next property.
Were you scared of debt?
I think I got, a little bit, but got into it in stages. So always, everyone's sleep at night factor I think would be different, but like for me, I had enough cash or equity to at least commit for that first one to go, okay, well, if it all goes wrong, I have to knock it down and sell the land.
Yeah, that's it.
then it's not going to financially ruin me.
Exactly. So you had an exit plan if all goes to crap. Yeah.
Yeah, and then as I kind of went into it, like, as you get more equity, more cash, well, my approach is you can then take on more risk, debt. Yeah, more risk, more debt.
That's right, yeah. So interesting, I've got to ask you about mindset in this whole process. Like what role has your mindset played in your ability to scale to 9 properties? And how did you handle fear and uncertainty when making these investment decisions?
Yeah, I think there does come a point where you do just have to commit and trust the process. Like there's been, there's a couple of times I can remember where I was like, what am I doing? Like one with my first investment property, so getting the pest and build report back for that. And, now I've seen like hundreds of pest and build reports, and I know what to expect. Like I know that it's going to be written in a certain way. I know that it's just completely focusing on all of the worst case.
That's it.
But back then, I remember I'd printed out this pest and build report, and I was going through it with like a highlighter, just like this. Oh my god, it sounds like it's going to fall down. And fortunately, he was able to speak to someone who was a bit more experienced than me at the time, who settled me to say that's just how they all are. Don't worry. Yeah. There's not really any major issues here. And in my recently, like the end of last year, doing my first flipper project, like I was in like under a high set in Townsville. It's pouring with rain. I've got my partner, I've got the tenants, I've got the real estate agent, the pest and build inspector. Like it's an absolute dive. Like there's graffiti on the wall. I can't see. It's dark. I can't really see anything in this underneath this garage, kind of under this high set. And I was just thinking, what am I doing? But to get to that point, I knew like I had trust in the process, trust in the data, and I was like, well, if it all goes wrong, it all goes wrong. But like,
so did you have like? Let me just backtrack one question. I want to ask you your major motivator and your major fear, because a lot of people, when they're thinking about building portfolios, there's like parents in the ear, don't take on too much debt, or the market could crash, or there's all these fear factors holding people back. What was your greatest fear factor, and what was your biggest driver to get into the market?
Yeah, I think my driver was actually, I guess, a little bit fear, but it was fear of staying the way that things were, and so because seeing my money get eroded, like that was almost a guarantee. It's like I realised I am invested. I'm just invested in cash, and cash is losing 3% a year on average historically over the last 35 years or so, versus historically property grown on average 7% a year over the last 35 years or so, and can be leveraged. It just seemed like a excellent. Based on history, it seemed like a really sensible move to.
Perfect. I'd love to tell us and our audience, just if you could break down one of your deals, maybe just tell us what you paid, where you bought it, what sort of strategy, and I guess what made it successful.
Yeah, so there's a few good ones. They're really good. Yeah.
Happy to hear
more.
But
again, this is I know we set expectations really high with what happened in COVID. So I wouldn't say that I would expect to get these types of results now. COVID was an extreme time, but like so south of Perth, there's one there that I've still got hold of I bought for $335,000.
What kind of property was it?
Yes, it's a 3x2. I think it's 2009 build. Yeah, freestanding house, of course. Not on a huge block, that one. I think it's like 550.
Okay.
That would be worth, sort of 625 now.
What suburb?
Bertram, in the south of Perth, in Kiwana region. So that one would be worth about 625-ish now, and rents for 600 a week.
Fantastic.
So, yield on purchase of that one is ridiculous now. It's like 9-10%.
Awesome.
But it's been able, or given me the ability to be able to buy others because of how much equity growth has been in there. And another one, was again in Armidale in South Perth. This was my partner's one. That was probably the most extreme passive buy and hold growth. Bought that for 332,500, and we sold it for 591,000 18 months later. So, yeah, in terms of return on capital,
Fantastic.
absolutely ridiculous.
Brilliant. Yeah. What was the reason you needed to sell it? Were you just trying to build up cash flow?
Yeah, so for her, like we for serviceability reasons, we're kind of separated on paper. So yeah, she's selling that one to then buy two more in trusts because if she continues to try and buy in her own name, then she'll just get stuck. And we saw that market, it was quite, it's like 45% investors.
Yes.
And we started to see the yields.
Yeah, a bit more competition with the rental market. Yeah, that makes sense.
Starting to sort of tail off. So it just made sense for her from a borrowing power perspective, like in her journey to sell that one. Yep. Because, as your property grows, unless you're refinancing all the time, which, generally speaking, that might not be the worst idea, but if you're not, then your return on capital is getting less the longer that you hold on the property because you've got more equity in there. So, when you look at how much equity she had in that property, like 250,000, what return was she going to get from keeping that equity in there versus using it somewhere else?
Yes.
Even though the transaction costs of selling and buying were quite high, it was still probably worth it because we saw that market was likely to sort of tail off a bit, and the opportunity cost was really high. So yeah, sometimes it does make sense to sell as well. Not,
You raise a really good point, which I'll just pick up for the audience, and that is you decided to sell because there was a greater opportunity cost of keeping that property, and you could get a greater rate of return on your equity by selling. And that's the key thing. When you crunch the numbers, it's all about the numbers at the end of the day.
Yep.
If you can pull the money out, I'm generally a holder. I very rarely sell. But when you do sell, if there's a much, much better opportunity and you're going to have a much bigger gain, it just makes financial sense. So
yeah,
that's what I say to people. Tell me how you kept yourself educated. Like, how did you you mentioned YouTube at the beginning, but how did you educate yourself and then stay ahead, of the market? Because the market keeps changing all the time, right?
Yeah, it is. It's definitely like overwhelm, I think, now compared to 5 years ago in terms of the amount of content that there is now. It's just
It's paralysis analysis. Everyone's got an opinion, right?
100%.
Especially around the barbecue. Yeah.
Yeah. And I think there's kind of, for me, there's I just had to narrow myself down to that. There's truth to many ways you can make money in property, but for me, the simplest and easiest to get my head around at the start was passive buy and hold, and now I'm into more like the renovation side of it and the flipping side of it. But that's come off the back of building a base from the passive buy and hold. That's I've used some of the equity from the passive buy and hold portfolio to fund the flipping.
Great.
So people, and I think a fair amount of property investors do sort of, because it's kind of like owning a little business when you own a number of properties.
Exactly.
It does maybe give you the launch pad potentially if you want to go into business as well. Yeah. So I've always believed property is probably the best way to passively protect and grow your wealth. But the best probably return on investment is investing in yourself, in your own education, because it's exponential return potential.
How did you do that? Did you read books? Webinars, online sources?
I did a flipping course like last year. I've done a development course, all found through YouTube or Facebook groups and things. And then also just networking. People being around people who are doing big things in the space. It's amazing what you
found mentors along the way.
Yeah, definitely. There's some people who I really value their opinion of. People who run the courses that I've been a part of, especially that I would look to for advice. Anyone who's, I'd say, ahead of you in your journey is going to be really useful. Most likely.
Awesome. That's fantastic. What's your view, Jono, on diversification? Like, a lot of people say, just stick to your lane, just buy in one or two areas, but a lot of other people say, buy across Australia. Do you prefer to stay focused in certain regions or spread across different states, and why?
Yeah, well, I think if this was going back a little bit when I was in Melbourne, I had that same mindset of the market is only the market around me. But that is really going to limit you if you only can invest where you can be around, because there's only so many places realistically you can drive to around you. So yeah, I as part of my initial kind of getting comfortable with property investing, also got comfortable with the idea of having to be able to invest in areas that I didn't live. Because yes, property goes up at 7% a year, but if you look at pretty well any market, it doesn't go up at 7% a year every year. It goes through phases. There's the process of the growth cycle. Then developers typically will come in and they'll build. The growth will usually stagnate for a while, and then the demand will pick back up again, and then you'll grow again, and and then the developers come in. So it's the cycle. So it doesn't grow in a nice even keel. So if you're just in your area might not be the best time to invest right now in the cycle.
So many people are scared about investing outside their backyard. They go, I wouldn't invest in Melbourne or Queensland because I just don't know it, or I wouldn't invest in Perth because it's too far away, or whatever. But they're missing out on so many opportunities.
Yeah,
by limiting themselves that way.
It's completely, and I kind of was the same. Like when I going my first investment, I was like, I kind of wanted to be in Melbourne or Victoria somewhere, like close, like even within an hour or two, so I can go and see it. But it's like, I know nothing about property. It'd be like, I know nothing about cars. And so I'm going to be turning up into an area that I don't know, never been there before, or not often, likely. I have no expectations of what what's normal in that market from the tenants. I'll have, no idea as well in terms of, I'm not, I don't come from any construction background. I've no idea how to assess the quality of the build as well. So you're always going to rely on professionals to do that anyway. So you'd be like kind of just kicking the tires on a car and saying that looks good. Like
We really appreciate you tuning in to the Property Buyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word of mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer Podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links. And now let's get back to the podcast. Tell us about, if you're happy to share, the biggest mistake you've made, and what did you learn from it along your journey? Have there been any clangers?
I mean, recently with my renovations, I got really enthusiastic after my first 2 flips because they went really well. And then I took on 2 bigger projects. Like, I'm doing 2 in Rockhampton at the moment where it's like re-roofing and re-stumping, and they're like 5-month projects. And it's, I've learned the quick and clean flips are probably a little less stressful. The longer, the bigger the overall build cost, the bigger the potential for delays, and that's exactly what's happened with the weather up there, and also the budget as well. Fortunately, in the right markets, that's cushioned it a lot. But for the stress of it, I'd probably stick to the quicker ones. Another probably mistake, which was just ego driven when I was starting to build up my portfolio, was wanting to have a property in every state. So I wanted to buy, I thought it would sound cool if I had said I have a property in every state. So I sort of pushed to get a property in New South Wales, where New South Wales had just grown so much through post-COVID, and I should have just got another one in Perth. And that probably cost me 200,000, 250,000, that decision.
Of growth. Well, timing's important. It's not the only thing, but it's important to learn from those mistakes. I think it's a really good point. So if you're sitting across the table from someone who's listening to this and they're just starting out fairly early on in their investment journey, what sort of advice would you give to that sort of early investor that's just starting their process?
I think you have to get comfortable with the fundamentals of the decision that you're taking in terms of the investing in the asset class. And so my process for that was looking at historically what has happened. Property prices historically have gone at 7% versus cash not done that. So if you're kind of comfortable with that really broadly, then that would be the sort of first step I would suggest to know that you're probably onto a winner historically.
That's good. And I guess off the back of that, what's your overall investment philosophy? Do you go for capital growth or do you go for cash flow? What sort of philosophy do you have around property investing?
Yeah, like I think really property is all about capital growth, isn't it? Like cash flow is just kind of the oil in the engine. Like the capital growth is the engine. It's typically yields don't keep up. I mean, apart from maybe the extreme examples of Perth I gave earlier, but if you're buying a property for 500,000 and it gets to $1 million, your rent per week is not going to be unlikely to be $1,000 a week. If you look at $1 million properties at the moment, they're not. The rental doesn't keep up because you've got apartments as a substitute product. Right. So the cash flow is just what's needed to hold on to it. It's the capital growth that creates the vast majority of the wealth.
Does the heavy lifting.
Yeah.
Yeah, cool. Okay. I guess also in that, what sort of investment criteria do you recommend when selecting a property or a property strategy? What do you look for in either a location or a property type?
Yeah, I mean, type-wise, I always go for freestanding houses. Like anything, you can do well in apartments, but I don't know how to do that well. I think you'd need to be choosing something unique. The land is scarce, so it's the land that's appreciating. The building is depreciating because of the sort of money printing. So, they're definitely big believer in houses over apartments. In terms of like locations, how to select the right locations is probably a lot more than I could think of off the top of my head in terms of all the data, but like on the supply side it's probably easier to explain. So we'd look at, building approvals numbers, we'd look at the council's strategic vision for an area, like over the medium term. Building approvals would be more like in the short term, how much supply have we got coming onto the market. Medium term, we might also look at developable land supply. You don't typically want to be buying like on the edge of the urban sprawl where they're just building their next round of house and land packages. On the demand side, there's quite a lot, but some of the ones I can remember off the top of my head would be things like the online search interest, so looking at trends on real estate and domain. How many properties are available for sale in an area, how long does it take them to sell, how much discount on average are people selling for, vacancy rates. It's all of these and more, and the trends of these over time. We typically will look at areas every few months, and then we're just in the areas. So the model that we use is just based on statistical regression analysis, basically looking at over time, historically, what variables have the highest correlation with capital appreciation, and then off that we can sort of determine what areas are most likely now to give.
I think the key thing you're saying, which I totally agree with, is we're looking at the data. Like for all of our clients at Propertybuyer, we look at the data, as you say, and we're tracking it monthly. And you can see trends. You can see that if days on market is starting to go up, or days on market's going to go down, that's showing you a trend. Or if vendor discounting or vacancy rates or online search interest is waning or improving, that's going to have a certain trend. So there's certain what I call inflection points in different markets. But in terms of choosing criteria, for me, it's the critical ones, which is supply and demand is the overall catchphrase. But for me, it's population growth is critical, infrastructure and massive infrastructure opportunities and growth in that, and also diverse employment opportunities, because it's essentially the home buyers and the tenants that'll be funding the property demand, which is the critical thing to seeing prices go up. So if there's lots of land supply and not much demand, guess what's going to happen? Prices are going to flatline or go backward. But if there's a lack of supply, really tight zoning restrictions and high demand, guess what's going to happen? Prices will shoot up. So it's about getting those things in combination for an area. I did sort of mention in my introduction about you made a return of, I think it was 155 grand or something on a deal. Is that right?
Yeah.
Can you tell us a little bit more about how you managed to do that? Are you happy to share?
Yeah, for sure. So that one, that was a flipper project. So I mean, I could have hold on to it, but So that was direct to seller. So we've bought properties even for clients from direct to seller from Facebook ads. Not Facebook ads, Facebook groups.
Yep. So no agent involved.
No agent involved. So this one was one of them. So this was actually a letter drop. So I have I've been flipping in Townsville and Rockhampton, so I've got people up there who've been just walking around dropping letters into into letter boxes to just sort of say, you know, hey, I'm a renovator, I'm looking for properties to renovate in your area. Give me a call if you're looking to sell. And that was how I came across that one really. It was someone who, just wanted a quick sale. They'd had bad experience with an agent, which probably not that uncommon. People like to sell without an agent as long as they feel that they can get a reasonable price. Yeah. And got quite lucky in that. I don't know if she really had appreciated how long or how much the market had grown around her over the last year or so. Yeah. But she was just done with that property. She just wanted a quick sale to get out and back down to her family in the south. So got that one really under market. Yeah. And
how much under market do you reckon you got for?
Yeah, that was a crazy buy. That one probably I would say at least 130,000.
That's amazing.
So most of that I probably could have turned around without actually doing any renovation and just made money on it, or a good amount of money on it. But we spent about 25k just fixing up the bathroom and flooring and painting and things, and got a good price for it as well.
Okay, fantastic. Well done. Good initiative. I guess the title of our topic today is 0 to 9. A lot of people get stuck on buying just one investment property. If you look at the tax office and the records, they show that a lot of investors sort of peter out after 2 properties or even 1 property. How can the average investor buy multiple properties over time? And how do you get finance to secure so many properties?
Yeah, I love that stat. And do you know, I was quoting that stat for so long as well. And then it occurred to me like probably 12 months ago that it might be slightly misleading because it might not actually capture, because that's from people's personal tax returns, isn't it? So the way that you would own properties outside of that is trust, which might not be captured in that stat. True. So it's through, it's a game of finance as much as of buying the right assets, as of course you know, but it's.
So how do you play that game? How do you win?
So trusts are a way that you can buy property, or you can buy a property in a trust rather than in your personal name. Just called a discretionary trust typically is the vehicle that investors use to do this, or a family trust, same thing. Certain lenders, plenty of major lenders have a policy that mean that provided that a trust is self-sustaining and that's substantiated by an accountant's letter, meaning that your investment property or properties within a single trust entity, take care of themselves.
It doesn't rely on your personal income.
Exactly.
You've got the rental income to rely on.
That's it. So they're kind of their own little businesses that you can silo, and then they are not considered as part of your serviceability calculations, essentially. So it's probably not the way that I would suggest to people who are starting out to buy property, because there's already enough complexity, and it just does generally suit people who have either a fair amount of cash or high income or both. And so, if they don't have either, then I would say starting off in your, buying in your personal name first is generally the way to go, because you're going to get the depreciation benefits. There's less cost.
And also the land tax benefits. I think one of the key things to point out, if you're buying in a trust or particularly a company, you won't get the full land tax threshold in different states. Each state has different land tax thresholds. So if you are buying in a trust, the thing for the audience to understand is that it will cost you more, but it means you can actually buy a property versus not having the property at all. So yes, it's still worthwhile, but there are a few extra costs you've got to cope with.
Yes, the thresholds in most, in some states it's 0, isn't it, in trust, and in others it's lower. And so I would say people starting out their first one, unless they have, probably simpler to do it in their own name.
But how did you kind of get multiples? Like, what was your little your finance trick to buying your next one and then your next one? What happened?
So you're gonna have to use cash or equity or combo. And so, like for my partner, that like with the one I was talking about earlier, so her journey might be more representative of someone had a reasonably modest income. So she bought her first property in Perth. It's grown a few $100,000 after a few years, and she's now got her second one. She bought it in a trust, because if she bought her second one in her personal name, that would have been it. She wouldn't have been able to buy another one. And now she's gone back and she's sold the first one, and with the cash that she's released from that first one, she's now going to be able to buy 2 more in in trust that will be self-sustaining because from day one, because she's got the extra deposits to do that.
Yeah.
So it's.
So I think one of the things you've got to be careful of here is trying to do too much on your own, like especially when you're buying multiples. I think anyone listening to this, you need a team around you. You need a great accountant. You need a fantastic mortgage broker. Highly recommend using a buyer's agent and getting a great solicitor, pest and building inspector, which the buyer's agent can recommend. But having that A team beside you is critical. But particularly you talked about the game of finance, Jono. I think that's really important. How do you find a good broker? I mean, do you find there's difference between mortgage brokers?
Well, my approach was just to kiss a lot of frogs, basically. Eventually, I found one. I went through probably 15 brokers before I found the ones. This is back when I'd just seen people have 10 plus property portfolios, and either they were lying or there must have been something that I didn't know. And it was the finance game that I didn't really understand. So I think finding the best brokers. My accountant now and the broker that I use, they're both property investors themselves.
Excellent.
I'd say if there was one criteria to look for, if you're choosing a professional or accountant or broker, it's probably that, because they're going to really understand the game more intimately.
That's really cool. A lot of people or homeowners have lots of equity in their home, but they're often afraid to use it. Like they've bought their first apartment or first house, they've got equity. Let's say they've got a $1.5 million home and they've got a $500K mortgage left on it. And there's $1 million of equity. I mean, you can't use that entire $1 million, but 80% of the value of the property. But they're kind of scared. What's your view on should that person pay off their home loan first before investing, or should they think about investing now?
Yeah, obviously I'm going to be biased on this. I think I know where that advice comes from, which is because. Be a bit careful with financial advice as well, but
this podcast is not financial advice.
Not financial advice.
Exactly.
Not a financial advisor.
But I'll tell you what I've done. You can say what you've done. That's fine.
And I used to, and up until I started investing in property, I just invest in index funds, and 7 to 10% steady, Eddie. But when I saw inflation at 8%, it's like that's not really going to cut it.
You can't leverage that, you see. So if you're putting 200 grand into an index fund, it's not leveraged. If you've got 200 grand cash, you can go and buy $1 million property. So you get 5 times the return. So instead of getting 7%, you're getting 5 times that return in a property.
100%. That's why I realised as well. It's like if you buy $500,000 property, if that grows 7%, $35,000, and it's cost you $100,000 to hold it, you're essentially getting 35% return rather than 7%. So I think that advice comes from maybe versus index funds and stocks and things. I would probably pay down my mortgage before I invested in stocks, because you're going to save yourself 6%. Well, that's after tax. So effectively, maybe 9-10% pre-tax versus what you might get from the stock market return. But like you say, the leverage is the difference.
Yeah, that's key. If you had $1 million in equity today, what would you do with it?
Yeah, well, what I am doing with equity, is to the risk level I'm comfortable with, taking it out and leveraging it up to buy more assets, because it's just the economic reality of this environment, isn't it? It's they're not going to stop printing money.
That's right.
Hard assets are the best way to hedge your wealth and stop erosion of that from inflation. So
exactly. Well, talking about inflation, we've got Trumponomics and the whole world order turned upside down at the moment. So a lot of people are scared to do anything. We've got an election coming up in May. We're recording this in the middle of April. So the election will probably be a very close minority government or home parliament or whatever it's going to be. But a lot of people are scared to move forward. But in fact, during times when the share market tanks and it's inflationary, property is the best hedge against inflation, Jono. And I think a lot of people are scared to do anything, but honestly, buying properties are going to be a great strategy. So the bond markets are predicting 3 to maybe 4 rate cuts this year instead of 2. So we're going to get a much deeper cut in rates than everyone's expecting. What's that going to do? Stimulate the property market again. So again, my advice to anyone listening to this is, now's a great opportunity to act. Not being biased just because I'm a buyer's agent. I'm just saying the reality is the market will really kick up. But talking of buyer's agents, what do you think as a buyer's agent, what advantage do they bring to the table for our property investor clients?
Yeah, I think probably one of, or certainly a key advantage is the the proven track record with agents. So, even knowing where to buy now, with the amount of information that's out there, there's certainly a lot of opinion and differences, but probably isn't the hardest to find some places to buy, but actually being able to buy there is a different thing. So, having proven track record with agents of successfully representing serious people who complete transactions, it really gives you with most agents anyway, it gives you really good leverage to then get the tap on the shoulder when they've got the off-market property. They're going to come to you because of how many times they've successfully transacted. So you're leveraging that relationship essentially when you're using a good buyer's agent.
Yeah, awesome. Anything else you think is a good advantage?
Yeah, I mean, as I was saying earlier, like if you're going with people who are further ahead of you maybe in their journey, have the experience, that's only going to stand you in good stead, isn't it?
Yeah.
Trying to do it all on your own was it was a bit much for me when I was buying my first property 5 years ago, I guess with all of the information that goes into selecting areas, building relationships with agents, it would have taken me months. So the speed that a buyer's agent can give you as well actually does have a cost to it. Like if I would have done it myself, it could have been 6 months, 12 months potentially to learn or more. And there is a cost to that, like the opportunity cost of not being in the market.
Well, I was going to say, let's say it took you 12 months to buy into a certain market. Let's say it's a Queensland market, for example, but yet that market moved 8% or even 10% in a year. The buyer's agent fee would be no more than 2%, right? So you're going to be ahead anyway. So you might as well take advantage. And the buyer's agent's going to give you the strategy, they're going to have the connections, they're going to do it much more efficiently, they're going to educate you. So it's really a no-brainer.
Pays for itself, within a month or two in the right market.
I've only got a couple more questions for you, Jono, before I let you go. But has your investment strategy evolved over time as you've got more knowledge? Have you got sort of more sophisticated? Just tell us how that's evolved.
Yeah, I'd say as I've got more kind of buffer in terms of equity, I've been comfortable taking on more risk, and so that for me has turned into more of the like renovations side of it.
I like the way you use the word buffer. It's a really good thing to have a buffer.
Definitely. Like
sleep at night factor, right?
100%. Like even now, like I look at, because there's projects I've got going on, and then there's total amount of debt that I have on the passive properties, and it's like, okay, where am I comfortable at? Because I could take on more, but I've got to be able to breathe. So I think that's a journey for going into the renovations is quite a common path. And then I'm interested in potentially developments and things into the future.
Awesome.
So that might be somewhere I go as well.
Fantastic. How many properties do you need to retire?
It's a little bit like how long's a bit of string that one, isn't
it?
it?
Well, let's say if you want 200 grand passive income.
So 200 grand, really basic plan for it. So 200 grand passive income. So what, if you, I would say properties are a great vehicle to get you to retirement, to create the asset base. May not be the best vehicle in a retirement because like we were saying earlier, like your yields don't typically keep up. If you've got 500,000 of equity in a property and it's yielding, 3 or 4%, then it's I'd say you could probably do better than that in a retirement. But in terms of getting you there, it's the best vehicle that I'm aware of.
We've created on our we're about to create on our website a retirement calculator, so people can go and put in what they want income they want to achieve, whether it's 100 grand, 150, 200 plus, whatever the number is, and then it will tell you what value of property you need to buy, and then break it down to how many properties you need to buy. It's not just the number of properties, right? Because it's all dependent on what they're worth, right?
Yes.
But you need to get to a certain level of asset base, and it's not 2 properties unless they're $5 million each, right? So I think the fallacy is, I can buy 2 properties and I'm set for life. Sorry, it's going to be more than that.
So I think the 2 million.
Exactly, but the mindset needs to shift, is what I'm saying here.
Yeah.
That you've got to understand. I mean, I was really averse to debt when I first started. I was really scared about taking on more debt. I don't want to over leverage. But as I've understood how finance works, I go to the banks and go, give me as much as you can, please. I'm addicted to OPM, other people's money, right? So if I can get more from the bank, because they've done their serviceability buffer ratios, they know they're only going to lend me up to a certain number. So why not get all of that invested in good assets? You know, that's the game that I've learned how to play over time. Do you think there's an age that you can get to where property investing doesn't make sense? Like when you get to 60 or 70, or do you think there's an age where you go, you know what, it's probably not worth investing in property anymore?
It could always be part of like a portfolio, I'd say, but yeah, generally as people get to, you know, whether they're 60 or 70 or just in the retirement phase, they tend to consolidate debt, don't they, and look for more income producing assets, you know, because property, as we've touched on, is the wealth's all built in the capital appreciation and the leverage. That's illiquid. So in a retirement, you're probably going to want to transition to maybe high yielding, you know, so commercial property is one commonly that I see people who are looking more for yield that they would focus on. But even like, you know, putting it into your super and getting 7 to 10% in a retirement might still be, but you know, it's more liquid, isn't it? More accessible. But to get to that balance to put into super, I would say, you know, property is probably going to be one of the best ways to sort of do it.
Very stable. Perfect. I mean, let's say you had, you know, $5 million in the share market and it's tanked 20%. Well, you've lost $1 million, haven't you? So, or if it's property, it's not going to drop quite that much, is it? You know, it's pretty unlikely. So, one last question for you, Jono. You've been great. Can you share the best piece of investment advice you've ever received?
I think the best for me is trust the process and commit.
What does that mean? Trust the process.
So once I'd come up with once I'd looked at all the data and it all made sense. There was still some fear. But it's just trust.
Committed to it.
Just commit. Commit and be okay with. I was okay to be wrong. Like, but I didn't see that I was wrong because I would have at least learned something. You know. With the information that I had at the time, I was still right, and it was still the right decision for me. So I was okay to live with whatever the consequences were. And fortunately, they turned out well. So
fantastic.
Commit.
Look, Jono Roy, it's been a pleasure chatting with you. Thank you so much for sharing your wisdom on the Propertybuyer Podcast. We really appreciate it.
Thanks for having me, Rich.
Thanks everyone for listening. I'm Rich Harvey, CEO at Propertybuyer. We look forward to you joining us for another edition of the Propertybuyer Podcast. Bye for now. Thanks for being with us on another Propertybuyer Podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry and we'd be delighted to help. Please visit our website at propertybuyer.com.au where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Propertybuyer Podcast.